Sandy McKay. Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoen here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Sandy McKay. So, Steve, we've got some interesting developments coming up with the Bank of Canada set to announce their interest rate update this Wednesday.
That's right, Sandy. There's a lot of speculation around whether the Bank of Canada will cut its key interest rate. With the central bank having held its rate at 2.75% for the third time this year back in July, there's anticipation building up.
Sandy McKay. It seems like the economic environment is nudging them towards a potential cut. With weaker job data both here in Canada and in the United States, experts like Penelope Graham from ratehub.ca are predicting a possible 0.25-point rate cut.
Yes, Graham mentions that the evidence is mounting about tariffs impacting economic strength, which could justify some short-term stimulus. There's also the aspect of the U.S., Federal Reserve potentially making a similar move, which might give the Bank of Canada some leeway.
Sandy McKay, and let's not forget the new inflation data that's due just before the announcement. If there's progress in those numbers, it might further open the door for a rate cut. But despite that, Graham cautions that core inflation metrics are still elevated, so the Bank of Canada might be hesitant to provide too much stimulus at once.
That's a good point. The balance here is crucial. On one hand, reducing rates could help stimulate the economy, but if done too aggressively, it might lead to inflationary pressures down the line.
Sandy McKay, absolutely, Steve. It's a delicate dance. Now, how do you think this potential rate cut could impact the mortgage and housing markets?
Well, Sandy, with bond yields already dropping, we're seeing downward pressure on fixed mortgage rates. The Government of Canada 5-year yield is down to around 2.7%, which is bringing fixed mortgage rates below the 4% threshold again.
Sandy McKay, that's encouraging for potential buyers. Graham advises borrowers not to wait for further rate cuts if they're considering a mortgage. Locking in now could guarantee access to the lowest fixed rates for a longer period.
Exactly. It's all about risk tolerance. Variable rates might offer more savings this year, but fixed rates provide certainty. If the Bank of Canada does announce a 25 basis point cut, we could see variable mortgage rate payments decrease, which would be a relief for many homeowners.
Sandy McKay. Right, and it seems like the market is in a sweet spot for buyers right now. Real estate prices are stagnating, inventory is ample, and lower mortgage rates are making it more affordable. But as Graham notes, further rate cuts could lead to increased sales activity and competition.
It's a dynamic situation. For those wanting to stay updated, following the Bank of Canada's announcements could be crucial. They've got key updates scheduled for this Wednesday and later in October and December.
Sandy McKay, indeed. So listeners, make sure to keep an eye on those updates and consider your options carefully. There's a lot to think about and staying informed is key. Let's see how things unfold this Wednesday. Sandy McKay, shifting gears a bit, Steve, let's talk about some interesting insights from Equifax, who are predicting a change in the mortgage activity landscape after years of stagnation.
Yes, Sandy. Equifax Inc. is forecasting that we'll see an uptick in transaction volumes, which could be a significant turnaround for the housing market. The company suggests that a decline in interest rates, combined with potential policy changes, like the Trump administration declaring a national housing emergency, could boost their mortgage business.
Sandy McKay, that's a fascinating perspective, especially considering the prolonged period of high interest rates and housing shortages we've experienced. Equifax seems to be optimistic about this potential recovery, estimating that if mortgage volumes return to their historical average, it could mean an additional $1.2 billion in revenues and $700 billion in adjusted earnings before interest, taxes, depreciation, and amortization for them.
Indeed, Sandy. It seems like Equifax is positioning itself to capitalize on this potential market shift. The stock is currently trading at what they consider fair value, and they're projecting a 15% yearly return with limited downside risk. This offers an intriguing opportunity for investors who are keen on stable growth.
Sandy Mackay. It certainly does, Steve. However, it's important to remember that these are projections, and various factors could influence the actual outcomes. While Equifax is optimistic, the broader economic conditions, such as inflationary pressures and housing supply challenges, will play a crucial role in determining the reality of these forecasts.
Absolutely, Sandy. And while it's always beneficial to look at optimistic forecasts, investors need to remain cautious and consider the potential risks involved. As the analyst from Triba Research mentioned, the focus should be on long-term value creation, ensuring that any investment aligns with one's financial goals and risk tolerance.
Sandy Mackay. That's a great point, Steve. For our listeners, staying informed and critically evaluating such forecasts can help in making well-rounded investment decisions. It's about balancing optimism with realism and ensuring that you're prepared for different market scenarios.
Right, Sandy. With the housing market's dynamics constantly evolving, keeping an eye on developments like Equifax's forecast can provide valuable insights. As always, thorough research and due diligence are essential when considering any investment opportunities.
Sandy Mackay. Sandy Mackay. All right, Steve, let's delve into our final topic for today. The Canada Mortgage and Housing Corporation has released a report suggesting that rent controls might do more harm than good. This is a topic that's been hotly debated, especially in provinces like Ontario, where rent controls are in place.
Steve Hamowen, indeed Sandy. The report from the Canada Mortgage and Housing Corporation, or CMHC, is urging provinces to focus on encouraging new construction rather than imposing limits on rent hikes. They argue that rent controls can stifle the housing supply by discouraging investment in new developments.
Sandy Mackay. Sandy Mackay. That's right, Steve. CMHC's stance is that rent controls, while intended to protect tenants, may inadvertently create a scarcity of available rental units. This is because developers and landlords might find it less appealing to invest in creating new rental properties if they can't adjust rents to reflect market conditions.
Steve Hamowen, exactly. And from an investor's perspective, if the potential for return on investment is limited due to rent caps, it could deter them from entering the market. This could ultimately exacerbate the housing shortages we're already experiencing.
Sandy Mackay. Sandy Mackay. On the flip side, supporters of rent control argue that it's essential for maintaining affordability, especially in markets where wages aren't keeping up with the cost of living. It's a complex issue with valid arguments on both sides.
Steve Hamowen, absolutely, Sandy. But CMHC's report suggests that a more effective approach might be to incentivize new construction, which could increase the housing supply and naturally stabilize rents through competition. This aligns with the broader economic principle that supply and demand should drive market dynamics.
Sandy Mackay. Sandy Mackay. Right. And CMHC is pushing for policies that could encourage developers to build more, such as tax incentives or reducing bureaucratic hurdles in the construction process. It's about finding a balance that addresses both affordability and availability.
Steve Hamowen, exactly, Sandy. And it's crucial for policymakers to consider the long-term impacts of rent control measures. While they might provide short-term relief, the potential for long-term consequences on housing supply cannot be ignored.
Sandy Mackay. Sandy Mackay. It's a nuanced topic, Steve, and one that requires careful consideration from all stakeholders involved. As always, staying informed and understanding the implications of such policies can help us navigate the complexities of the housing market.
Steve Hamowen, thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Sandy McKay. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.